Thank you very much, Equitas, for arranging this conference, and thank you very much to all the participants for being here this afternoon. The quarter that ended in June 2020 for Symphony was, for obvious reasons, a dismal quarter, which is best forgotten. It is probably the lowest sales in this quarter in the last over a decade. But the way we see it, the worst is behind us. The current quarter and the quarters to come up to March 2021 will be much better than the last quarter. Although they will not match the performance of the same quarters in the previous year. Even as a year as a whole, we will certainly fall short of the previous year because we've basically not got any sales, practically no sales in the quarter ended in June. Moreover, there is significant inventory lying with the channel, most of which will only get exhausted in the next summer, which will be in the first quarter of the following financial year. So although this financial year will see a dip in top line over the previous year. However, in terms of profitability, we will be able to maintain it, and in terms of margin, we'll be able to maintain it. But basically, I would say that what this last quarter has vindicated our twin strategies of an asset-light variable cost business model and that of geographical diversification. And let me explain what I mean. Because of our asset-light variable cost model, despite such a dismal sales of top line of barely 40 crores, we've ended the year at more or less, we've broken even. Although of course we had other income to sort of cushion that. So operationally we have a minor loss, but this could have been far worse, as in the case of several other companies, had this been a fully vertically integrated manufacturing company. So it is at times like these that certainly the benefit of our business model of an asset-light variable cost model it helps. Moreover, our strategy of international and geographical diversification has helped, as is seen in the numbers, where the standalone sales of Symphony India is down by 75% over the same quarter previous year, whereas that at the consolidated level, it is down by 47%, and the international subsidiaries together are down by just about 12 or 13%. In fact, the sales of international subsidiaries together is significantly higher than that of the standalone India revenue. Because we have the revenue, because we have the top line, going forward, there is a possibility of the bottom line also following. In the last quarter, whereas in India's revenue shrunk dramatically, Australia's revenue was more or less on track with the previous year. In fact, had a marginal growth over the previous year. Mexico had a drop, from June onwards, was doing all right till May, but from June onwards had a major fall. USA has done much better than the previous year, although on a lower base, and China is more or less the same as the previous year. So sum total, as I said, the revenue from these international subsidiaries is significantly more than the revenue from India. And going forward with the measures that the company is undertaking, the bottom line would also be significantly better of the international subsidiaries than it has been in the past. In fact, even this quarter, in the June quarter, especially in Australia, the bottom line would have been significantly better were it not for the fact that because of supply chain disruptions, we were compelled to buy products either locally, which we were normally sourcing from overseas, so buying locally at a significantly higher cost, as well as we had to air freight some international components from international sources, and we also had to incur high labor costs. So were it not for these factors, the bottom line too would have been significantly better. Net, what I'm saying is that because of the revenue from the international subsidiaries, at least our all in all total revenue has still not really fallen off the cliff as much as India's standalone revenues have. Like I said, going forward, once our various measures to improve profitability, especially in our Australian subsidiary, are in place, then the bottom line will also be significantly better. So to sum it up, I'll say that we are fairly optimistic about the future. We have received fairly good response from our trade partners, although it's nowhere close to what it was in the previous years. But considering the situation, in fact, I would say that the response has been significantly good. And as far as the company's basic core proposition is concerned, it remains unchanged. The prospects for the air cooler category as a whole remain unchanged. They are as good as they were in the past. If there is a good summer, we will sell. As far as the company's, I would say, innovation engine goes, that keeps on churning out new products. New products will get added even in the current year. Trade and channel expansion will continue to happen, and marketing and brand building will also continue to happen. So whereas this year as a whole will witness a sort of a reduction from the previous year, we will still remain a profitable company, and this will be at the worst, I would say, is a year that we would all like to forget, and from next year onwards, once we are able to put this whole COVID situation behind us, Symphony should be back on track. With that, I hand over to my colleague Nupesh Bhai.
Yeah. Hello, good evening, and welcome to this conference call. So just to share and highlight of some of the key financials. On a consolidated basis, the top line for the quarter has been 154 crore, down from 292 crore, while on a standalone basis, it is down from 160 to 40 crore. Gross margin percentage on a consolidated basis is down from 45 to 39%, and on a standalone basis, it is down from 50 to 46%. There are two reasons. One, on a standalone basis during the quarter, there has been disproportionate higher value of spare sales. And on spares, the contribution and gross profit margin is quite low. As far as air cooler sales is concerned, the contribution and gross profit margin remains healthy as it was, which is in excess of 50%. While on a consolidated basis, apart from the Symphony India specific reason, there was one-time exceptional higher cost, particularly related to climate technology, which was on account of COVID, and the cost was higher mainly due to increase in purchase costs, local purchases instead of imports, and also higher freight costs, mainly air freight. However, we have succeeded in restricting these higher costs to June quarter, and because of variety of initiatives and measures which we have taken, we are quite confident to restore to almost normalcy in respect of this cost. As far as EBITDA is concerned, on a consolidated basis, it stands at about 2 crore versus 16 crore in June 19, and at a PAT level, it stands at about 2 crore versus 16 crore year before. I'm sorry, 2 crore versus 33 crore year before. As far as capital employed is concerned, on a consolidated basis, it stands at 320 crore versus 288 crore. There has been marginal increase in capital employed during the quarter due to higher amount of inventory as well as receivables, mainly in Symphony India. In fact, in overseas subsidiaries, the working capital has been further rationalized. And coming to geographical sales, sales in India has been 34 crore, while sales in the rest of the world has been close to 115 crore. So rest of the world has contributed close to 75% of the sales during the quarter, which includes sales from overseas subsidiaries as well as exports. And treasury stands at about 410 crore as on 30th June. Now, some of the highlights of June quarter in respect of the sales and performance, they were discussed in previous conference call, but as they pertain to June quarter, even at the cost of repetition, company at a company level as well as at a trade level, there was negligible or zero sales during April and May months on account of lockdown. However, once lockdown was lifted, since end of May and beginning of June, there was substantial sales and trade could offload almost 60% of the inventory. Not only that, some of the newly launched models during last couple of quarters were out of stock at a trade level as well as at a company level. In fact, during the June quarter, the company launched online to offline sales, and whereby the methodology was developed through which lakhs of consumers visited company's website, and many of them had confirmed the orders. However, on account of logistic constraints, there were sales of few thousands of calculators from the dealer point. And in respect of this online to offline sales initiative, this was unique not only in air cooler industry but in entire consumer durable industry. Not only that, on account of guidelines issued by WHO as well as several state governments and government of India, whereby open ventilation was recommended on account of pandemic, several high-end AC consumers in fact switch over to air coolers. Coming to international sales, there has been major reduction in terms of the exports from India, mainly on account of prevailing situation, and many orders got cancelled. However, as Achal said, we are very confident to maintain, even during current year, which is quite challenging year, to maintain our gross profit margin as far as air coolers are concerned. And we expect it to be in line with previous year. In fact, on account of lockdown, we have initiated, on account of lockdown as well as slowdown, we have initiated several measures on cost side and few other initiatives, and that should yield sizable benefit once normalcy returns. Again, considering the business model and some other initiatives which we have taken, current year, that is financial year 2021, our break-even sales is expected to be around 150 crore on a standalone basis. That is roughly 20% sales of the previous year sales, which was about 720 crore. Of course, this is subject to advertisement and sales promotion, which may alter this figure. And as Achal said, due to off-season collection we have received and the kind of visibility what we have, at least for current quarter as well as next quarter. Certainly current year, we will be in black. And about subsidiary companies, their performance has been quite resilient despite COVID. All put together, their sales was down just by about 13 to 15%, mainly on account of decline in sales in Inco Mexico and GSK China. However, profitability was lower substantially, mainly on account of increased purchase costs and local purchases instead of imports, as I said earlier, as well as higher freight costs, mainly air freight. However, they have been already corrected, and starting current quarter itself, we expect normalcy to return in respect of those costs. Thank you, and we can have questions, please.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Omkar Kulkarni from Shree Investment. Please go ahead.
As you have mentioned that you will be maintaining the EBITDA, so how do you plan to maintain it? There would be significant reduction in sales. So what measures are you taking to maintain the EBITDA?
I think when we say the profitability margin, it is in respect of the gross profit margin percentage, which on a standalone basis in air cooler is around 50%. EBITDA will certainly be a function of the top line, what we achieve. However, one, on account of business model, and secondly, even in current quarter, you would have observed that in respect of other costs, it is almost half vis-a-vis previous year. That is down from 15 crore to about 7 crore. One, on account of freight cost, which is of course a sort of variable cost. But apart from that, other indirect fixed costs like traveling and conveyance and legal and professional costs, they have also seen significant reduction. But because of our outsourced business model, we are not married to blue-collar employees or large factory overheads.
Okay, so in view of the current situation, you still having around 400 crores of cash on the books. So how do you plan to use that? Would you be reducing the dividend payout, or would you like to maintain it? Because there hasn't been any interim dividend, but you have given a large dividend last year.
Yeah, so in March quarter, we announced bumper one-time dividend, which vis-a-vis last year profit, it was in excess of 100% payout. And as we have maintained in the past year as a whole, we will like to stick to at least 50% payout. But obviously, in June quarter, it was not appropriate considering uncertainties as well as the performance to declare the dividend.
So overall, you will be maintaining the 50% dividend payout, which I have already alluded to.
Yeah, that's right. So total payout we are saying will be
Correct.
around 50%.
Correct. Okay, thank you.
Thank you. A reminder to the participants, anyone who wishes to ask a question may press star and 1 now. The next question is from the line of Renu Baid from IIFL Securities.
Yeah, Renu, go ahead. Maybe she may be on mute.
Aisha? Aisha? Hello?
The person you are speaking with has put your call on hold. Please stay on the line. તમે જે વ્યક્તિથી વાત કરી રહ્યા છો એને
Aisha?
Yeah, Manoj, can you hear us?
Yeah, Milind bhai.
I mean, I don't know, Aisha, we can't hear Aisha or even the question from Renu or someone else.
Yeah, just a minute.
Yeah.
The next question is from the line of Manish Agarwal from Edelweiss. Please go ahead.
Initial commentary, you mentioned about Mexico June sales is dipping sharply. So firstly, some color on is there something, some particular reason because it was like that? And the second question is on the Chinese subsidiaries. Since we are
Can't hear you. Please, can you speak a little louder?
Sure, sir. Just a Is it better, sir?
Yes, ma'am. Yeah, speak up, but.
Yeah. So, sir, the first question is on the Mexico subsidiaries. In the initial commentary, you mentioned that June as a month saw a sharp dip in the sales out there. So the first question is regarding, is there something, some issue going on in the subsidiary or the country that, suddenly...
COVID, because of COVID.
So the June sales, so April and May were good, but June saw a dip because of the COVID issue.
Yes, COVID hit them a little later,
Okay.
Which is why.
Okay. Sir, the second question is on the Chinese subsidiary. So, sir, we have already taken some markdown last quarter, and obviously the India-China skirmishes are going on. So, is there any possibility that we will be looking at, maybe selling off the subsidiary because it is still a loss-making subsidiary? So, any thoughts or color on that?
See, the subsidiary actually had turned, had broken even a year before, but because of the trade war and COVID, our sales took a dip and we ended in a loss. Otherwise, a year before that, we had already broken even, and in 1920 we would have actually made a profit, but because of the trade war and because of COVID, our instead of a profit we had a small loss. But in the current year we expect to at least break even. And the India-China issue I don't think has much bearing on businesses, because there are hundreds of Indian companies operating in China and Chinese companies operating in India. So I think as far as those are concerned, things are going on all right.
Okay.
And in fact, in the respect of contribution percentage during June 20 quarter, GSK China as well as Inco Mexico both have registered some improvement, even in respect of the gross margin and contribution margin percentage.
Sir, one question on the standalone entity, sir. You mentioned that the inventory still remains high in the domestic market. So if you could throw some numbers, maybe, what would be the trade inventory right now, maybe a 1 month or 2 month inventory that we see in the trade right now?
It's difficult to quantify in terms of months. First of all, we don't even know, because it is very dispersed. It is dispersed over thousands of retailers and across the country. So it is frankly anybody's guess how much it is, but it could be in the region of about 40% of last year's sales is still lying unsold with the channel. Is our guesstimate, but nobody knows for sure.
Okay. That's helpful, sir. Thank you.
The next question is from the line of Renu Baid from IIFL. Please go ahead.
Hello.
Yeah, Renu, go ahead.
Yeah, hi, sir. So the first question which I was asking, I think you mentioned that difficult to quantify inventory. But what is the kind of inventory in your view would be there across most brands as well as including Symphony? Would it be similar at 50-40% or more? And how would that compare with the previous year? Because previous year also there were similar issues of inventory being there in the channel, but at least it was mobilized.
So again, we really don't know how much inventory of our competitors is lying with the channel, but we believe it should be more than ours, for various reasons. And in terms of comparison with the previous year of 18-19, again, I would say this is somewhat similar to 18-19, somewhat similar inventory with 18-19.
Sure.
Second, as far as yeah, Renu, I think second part of your question was inventory with the company. Of course, as on 30th June, inventory with the company was higher than previous year, but we expect it to be normalized, and mostly in some of the models we will be out of stock in September quarter itself.
But what's the value of the inventory that you're sitting with today?
Yes, so company level inventory is non-issue.
But what is the value?
I think as on 30th June, the value of inventory was close to 40 crore or so.
Okay.
34 crores.
Sure. And in your opening remarks, you also mentioned that the capital employed also includes receivables, which in the standalone book. So typically we have this cash and carry model of business. So these receivables would be pertaining to the modern retail format, and what is the quantum and the risk related with these receivables sitting on books?
Yes, so it was higher capital employed was one on account of higher receivables, mainly modern retail and partly export. In export also, they were the receivables on our subsidiary company Inco, which have been subsequently recovered. And also, higher capital employed was on account of this higher inventory, which we just mentioned.
Correct. And so now, the second part of the question is, we have this typical pattern of starting the booking during off-season. I understand the market is not such that one would have anticipated similar kind of dealer events and off-season booking happening through. But based on whatever little assessment and interaction we had with the channel partners, what is the feeler in terms of the order booking that we are seeing?
So order booking is, I would say, sort of on track with the previous year, 18-19.
So would this be comparable to financial 19 in terms of overall order booking, or there would have been substantial contraction of 50-60% or so?
On 18-19, just a second. Not a substantial. There is a contraction from 18-19, but not a huge contraction from 18-19.
Okay. Right. So basically, as a business strategy, should one look at probably just like any other normal seasonal product now, one would anticipate the bookings to pick up only towards third quarter once we are closer to the season and the pandemic issues are broadly behind by then, or at least under control.
Yeah, you can say that.
Sure. And so my last question is, if you can help us quantify what are the exact cost actions that you have initiated, both in the standalone business as well as in climate technologies, to reduce the fixed overheads and improve profitability?
Most of the cost initiatives are not towards fixed overheads, but on the bill of material or the manufacturing cost, on the cost of goods sold. And so whether it is, I'm talking about at the standalone level, we have taken several measures to reduce overheads in Australia, China and Mexico. And of course there too we have taken measures to reduce the cost of goods sold. So in Australia our overheads will be, from the year before will be down by about 30%. In China also, will be down by about 20-25%. Mexico also maybe about 10-12%. But the major impact will be on cost of goods sold. Now again, all of that will not be visible immediately because it will be effective only on what is produced and not on the inventory, and that too in a phased manner. So a lot of these steps will bear fruit, over the next 12 months or so.
Sure. And last question to Mukesh sir, will it be possible to share subsidiary-wise at least the turnover as well as EBITDA or PBT numbers? That's the last question.
Yeah. So right now I don't have handy. I will share with you separately.
Done. No problem, sir. Thank you so much and all the best.
Thank you. The next question is from the line of Abhishek Ghosh from DSP Mutual Fund. Please go ahead.
Yeah, hi sir. Thanks for the opportunity. So first question is in terms of the vendor through whom we source, how is their financial health and other things? Because in light of no business and other things, then are you extending any kind of help to them? So how should we look at from that perspective?
Most of our suppliers or OEMs, as we call them, are very, have healthy, are financially quite healthy and sound. Some of them are very, very large multinational companies. So there are a couple which are, relatively not as healthy. But we are not really extending any kind of support to them. We don't really need to do that.
Okay. And sir, do you believe that since there is also competition also sources from a lot of these vendors, so sourcing, from them in a season, because one season is completely washed, So give this, scenario, how's the competition looking like? Because speaker and typically tend to pay after such a season. So how are you looking at the competitive landscape? I know it's a bad season, but I'm trying to understand the competitive landscape from that perspective.
Your voice was cracking in between, but are you talking about from a sourcing perspective? Then, our sources are not the same, our sources are not common. Our OEMs are exclusive as far as Symphony is concerned.
Yeah, I do understand
second part of the question was competitive scenario.
So, competitive scenario, I would say that, what's happened to us, I'm sure that our competitors have faced much greater pain than we have, as far as coolers go in the last quarter. Going forward too, we really, I would say, time will tell, but we think that some of them might be under severe stress. As far as the cooler business is concerned with inventory lying, and some of them would have receivables from the trade. So there would be a fair amount of, I would say, mess that they might have to deal with.
Sure. Okay. And so just one last question from my side. In terms of the industrial coolers, what's the state there and how should we look at that part of the business?
So as far as industrial coolers are concerned, we have invested in the previous year in developing a whole range of products. And it was last summer or this summer of 2020 where the products would have really been able to, sort of demonstrate their performance in the market. But unfortunately, because of COVID, that did not happen. Even going forward, now, because this is, as far as industries are concerned, this is like a capex. Although it's a small capex, it's like a capex. So people are sort of hesitant to sort of commit. So even the inquiries that were there in our funnel before COVID have all sort of slowed down. So it is going to be a challenge for that vertical too. Again, as far as the company is concerned, the investments are made, the product is there. Now we will use this time to educate the channel, impart training, expand the channel, and do all of that so that we are in place for next summer.
Okay, so essentially what you're saying is you'll continue to invest, but probably it will be a little delayed uptick in the overall industrial coolers, what the sense is, right?
That's correct.
Okay, sir. Thank you so much and all the best.
Thank you.
Thank you. The next question is from the line of Hussain Kagzi from Ambit Asset Management. Please go ahead.
Hi, thank you for taking my question. So I just had one question regarding the international subsidiaries. Like last quarter, I missed your first 2 minutes. Maybe if you highlighted them, if you could repeat. So you had said that mostly for most of them, the sales would be almost flat as last year. So are we expecting the same scenario, or is there any change in that in terms of sales and profitability for the 3 subsidiaries?
For sure, our Australian and Mexican subsidiaries will be profitable, although reduced profitability. Our Chinese subsidiary, may break even, may have a slight profit, or may even have a small loss. But again, the numbers of the Chinese subsidiary are, inconsequential in the larger scheme of things. I would say so. Even at the console level, the company will be profitable, standalone and console. And like I said, Mexico will have a small profit. Australia will also have a profit. So profitability is not going to be an issue again because of the business model. Mexico already has the asset-light variable cost model. Australia is in the process of adopting that model, and will take another year or two for the entire, maybe 2 years for the entire model to be in place. But that's the direction in which it is headed. So profitability is not going to be an issue. I mean, it will be a small profit, but it won't be a loss.
Right. And in revenue terms, I guess it will be almost like slightly 5 to 10% down. Okay.
Yeah.
Okay. And also, sir, we import to US through one of these subsidiaries. So is it the Australian subsidiary or the Mexican subsidiary that we import to US?
So it is a step-down subsidiary of the Australian company.
Okay. All right. Yeah, this is it from my side. Thank you.
Thank you.
Thank you. The next question is from the line of Naveen Trivedi from HDFC Securities. Please go ahead.
Yeah, good afternoon, everyone. Sir, in your press release, you mentioned that certain strategies taking the advantage of slowdown will result in sizable benefits going ahead. So what are strategies you are trying to highlight and what are benefits you expect?
Yeah. So as it was mentioned earlier, mainly in respect of the bill of material, also on account of the value engineering, and some of them are major initiatives, and actually on account of lull in the business and on account of this lockdown, we have initiated them. Very difficult to quantify specific strategy, also on account of competitive reasons. But there are a couple of initiatives, and once normalcy is returned, it should substantially help in respect of rationalizing the variable cost and thereby helping the profitability margin. And as far as subsidiary companies are concerned, as Achalji mentioned earlier, across the subsidiary companies, including overheads and also bill of material costs, several steps have been taken.
Okay. And with respect to channel inventory, like you mentioned about, it's very difficult to quantify. But considering North has seen a better summer this time, I assume that your inventory in the North region will be relatively lesser versus the other markets. So if you can just highlight the stress level with respect to inventories, and you mentioned that the trade behavior was better than the FY19. So can we expect that during this time the liquidation of the inventory will be easier than this last time?
Again, it varies, not only by region, but more by the entity. So there might be a distributor in the north who will have zero inventory, and there again might be another one, in the same city who might be sitting on inventory. And the same is true for the rest of the country. So, we really do not know, to what level there is inventory lying and where. Because once it leaves our go down in our distributors' warehouses, after that there is, we have no visibility of what happened to that. So as far as I said before, this year looks more like the year 18-19 than anything else. Maybe even a little shade less than 18-19.
Okay. Just lastly, of the CP's progress in US, you mentioned about that this quarter you have seen good traction in US. Just slightly longer term question: what kind of revenues do you expect from US over the next 2 to 3 years time frame?
I mean, we have ambitious plans for the US, and we believe that the US should be, something like equal to half of the Australian sales in Australia maybe in 3 or 4 years' time. So because the market exists and our market share is very small, so it's just a matter of market share acquisition, and so the potential is very much there. And we have the presence, we have the customer relationships, we have the brand recognition.
Okay. Yeah, that's all from my side, and all the very best.
Thank you. Thank you.
Thank you. The next question is from the line of Jeetu Punjabi from EM Sandeep Singh from Sundaram Mutual Fund. Please go ahead.
Yours, I love you. OneHappyBirthday.com.
Sandeep, your line is in talk mode. You can go ahead, please.
मेरे चैनल को सब्सक्राइब करें.
The next question is from the line of Jeetu Punjabi from EM Capital Advisors. Please go ahead.
Yeah. Hi, Achal and team. Good to see you guys fighting at this time and chugging away. So two broad questions. One, in this roadmap to normalization, and I'm assuming the virus fades out, hopefully, if you're right, by the end of the year. What timeline would you put to a normalization of the business, and what metrics would you use to calibrate that? And around that also, what do you think will be the one or two biggest challenges in this normalization?
Hello, Jeetu. Good to hear from you. We are all sort of keeping our fingers crossed that the vaccine, is rolled out before the year is over. And if that be the case, then from February, March onwards, the temperatures will pick up across the country. Inventory will get, exhausted in the channel, and we should be back to normal. So of course, everything depends on when this COVID goes. But other than that, if the COVID situation is, behind us before the next summer, then we are in good shape. Now, in the worst case, even if it lingers into next summer, as long as there is no lockdown, and we don't expect there to be a lockdown like we had last summer again. We should do all right. There might be some glitches of supply chain and issues like that. Some channel partners may not be able to open their stores, keep their stores open. But that won't be something an all pervasive kind of a situation. It will not be a lockdown like in the summer of 20. And regardless of what happens, I think summer of 2021, even if there is no vaccine and COVID continues, even then the summer of 21 should be much better than the summer of 20.
Okay, great. Now, second question is a broader question. If we, typically, there's an old saying that never waste a crisis, right? And I'm putting case in point that, you guys are superbly run, have a great business model, have executed beautifully over the last few years. What is the low-hanging fruit in terms of new opportunities and or acquisitions and or doing something completely different to monetize this crisis or to take advantage of this crisis and come out stronger, better, or do something bigger beyond it?
Well, we've really scratched our heads to see if there are opportunities here that we can cash in on. But other than the excess time that we all have, which we are devoting to cost rationalization or manufacturing cost or cost of goods sold rationalization, as I spoke about earlier, other than that, we are not really doing anything, very different. In terms of opportunity, I would say Australia. In Australia, we have been presented with an opportunity to grow our business because people are locked up at home. They had their winters going on, and so our heater sales were very strong because of that. But other than that, if you're looking for, if you think that we're going to be doing something very dramatically different, or some dramatic acquisition, nothing like that is actually on the anvil.
Okay, that's candid admission that. Okay, and you don't see any brands that are available in India that you think you could seed and build around over time?
No,
from
there
an
are.
acquisition standpoint?
No, there are. But then whether, there is synergy with them, we get an acquisition offer every week. But we have to see whether they make sense. There has to be synergy, there has to be opportunity. And we have so far not come across anything which offers any of those.
Okay. Super. Good luck, Achal. All the best. Take care.
You. Thank you very much.
Bye.
The next question is from the line of Devanshu Sampath from Yes Securities. Please go ahead.
Hello, sir. Good evening. So I had a specific question regarding your commercial, right? The MovieCool range that we have launched relatively recently. So just wanted to understand two things. Firstly, is it something that is manufactured locally or is it in China? Hello?
It is entirely manufactured locally. Till last year, we were bringing it in from our company in China, but then based on the technology of the Chinese company, we developed a range of products which we are now manufacturing in India. So we decided to go ahead and make those investments to save on freight costs, to save on customs duties, and to overall improve our profitability. So basically, to cut a long story short, those coolers are being made in India now, since last year.
Okay. So just a long-term sort of question here again, just to get a view on this. So a few years from now, would we be targeting the commercial space? Would it be a larger market in India or a size for us in India, or are we looking at exports as well to grow this business?
No, we are looking at both. International markets we are, certainly present in, but these have been produced in India, are being produced in India because the Indian market is very large. And of course, we will begin to offer them internationally too. Normally, whenever we introduce a new product for the first year or two, we don't export it. We only sell it locally. So if there are any teething troubles, we sort of iron them out, and only then do we export them. So going forward, we will begin to offer them to our international customers, and the market globally is also very large. In fact, next summer, it has been offered in Australia and in the US markets as well.
Yeah, so I want to actually dig a bit more into this. So from what I understand, we have air cooler companies like, Portacool, which is an American brand, and all these kind of companies provide their dealers with additional funds or budgets to sort of support, the advertising and promotions locally. So is that something that we'll also be required to do over time?
We do that. We have been doing that historically. It is all built into the pricing. We give them a sort of a marketing budget, as a percentage of sales, which if they spend, and then we reimburse. So it's not something that we haven't done in the past. It's something that we are doing, across countries. Okay, and when it comes to, the credit period that we give them, are we looking to stick to the way we function right now, or is something that we can dilute a bit to be a bit more competitive globally? Dilute what?
In terms of the credit days that we give them?
Internationally? No, internationally we don't give credit. Internationally we're not really giving credit.
So it is mainly against letter of credit, that is LC. It is an assured payment. But in books of account, until that amount is recovered, it is reflected as receivable. So we wish to stick to that. And it is not only in the respect of international business, even in respect of centralized and ducted air cooler. Even though many of the customers may be a large corporate, even to them also we have found the ways and means whereby we need not to have receivable. So in some such cases, we deal through the trade partner, and they grant the credit, but we receive 100% advance.
So now that we're manufacturing in India, will there be a substantial price difference or advantage that we have versus, say, a similar type of powered cooler that that is available in the markets that we're targeting specifically? Or will the price points largely be the same, like say around $200 or something of that sort?
Look, see, price point varies from market to market, So a US product could be more expensive. We might be offering the same product in, let's say, the Middle East at a lower price. So it really depends on the market.
Okay. And even within this, can the spare parts consumable business become a sizable chunk over time, or we don't see that? It can be other local parts can be available, so this cannot become a big thing for us.
No. There'll be no local parts available. Those parts will have to come from the company.
Okay, so that can possibly be a larger portion than what the current blend is right now.
Yes.
Okay. Okay, so that's it from my side. Thank you.
Thank you.
Thank you. The next question is from the line of Manjeet Bauria from Solidarity Advisors Private Limited. Please go ahead.
Hi, sir. Good afternoon. I had two questions. One, I just wanted to understand from a consumer behavior perspective, how long do consumers take before they switch out of their older cooler models into newer ones, just in terms of, replacement, if you have any data around that from your studies internally?
Unfortunately, no, we don't have data about whether they are going into the replacement market or into the, into first-time buyers. But most of our cooler customers, many of our cooler customers, I shouldn't say most, are not first-time cooler buyers. They may have a cooler. This might be another cooler that they are buying. Many are repeat customers. They might not be replacing their old cooler, but they are certainly repeating, buying a Symphony cooler for the second or the third time. Now, whether they are disposing of their old cooler or not, we don't know. So there are many repeat customers for sure.
Right, sir. Sir, my second question was a bit more, longer term perspective. Now, while at Symphony we really get to partner with a great team and a great brand and a great product, what happens, or at least seems to be happening, is, there is one element which is completely outside our control, right? And that is, if something goes wrong in the summer months, whether it be weather, whether it be a really one-off situation like COVID, but it really sets back the entire year for us. Now, if we think about this over a more 5-10 year perspective, how does the team think internally in terms of, how can you offset this? Where, there are no years where we suddenly go to almost, nil sales in the most critical period of our annual sales. And we have tried something like acquisitions overseas, but, in context of the Indian size, they are really small to offset that. So, unless we become a multi-product company or we really get a very big acquisition somewhere else, is it really possible we can avoid such situations?
Well, so like you rightly said, one thing that we have done is this international diversification through acquisitions. The other thing that we are doing is exporting from India. The third thing that we are doing is offering trade off-season discounts so that so that we have round-the-year sales even in the off-season months, when the consumer may not be buying, but the channel buys from us because of the extra discounts that we give to them. Now, these are the three things that we are already currently doing. Getting into another product entirely is something which, we've done that in the past, and we do discuss that many a times, internally. But unless it's a market adjacency, it is something that we would really not venture into, because we don't think that it is in our long-term interests, unless it's an adjacency.
And sir, we really appreciate that focus, but then I'm just trying to understand, will the implication of that be that we'll have to live with this volatility at periodic intervals, and as a management team you have aligned to that fact that that volatility is something which is just a part and parcel. And again, I'm coming from the fact that India is such a big business, and India will definitely keep growing much faster than anything overseas which we are trying to do, right? So the overhang of India will really be there irrespective of what we are trying to do overseas. And even in context of, let's say, US, for example, becomes half of Australia in 3-4 years. Just in terms of percentage contribution on the profitability level, it's not going to be that meaningful.
Well, yes. I would say that to some extent this volatility or the perception of volatility is also like an entry barrier, is a moat, and we've been able to weather it or manage it over the years. Not every company has been able to sort of, surf this wave.
Very fair, sir. Because we love partnering with Symphony. Right, I'm just getting this broader question though out there, because that is something we have to tackle in the longer run. So, just wanted to understand where you were coming from there.
And because of this seasonal factor, many companies in the past have entered in air cooling business, and many of them, including some large consumer durable companies, have exited. And apart from all other products, now because of centralized and ducted air cooler, which is more like enterprise solution, is also going to help us in medium term to de-risk in that respect.
Okay, sir. Thank you.
And of course, we do sell heaters in Australia, which have helped, our sales this year. The fact that Australian subsidiary sales has grown a little bit over the previous year, YOY, is also because of the growth in heater sales. So that does exist too in Australia. And locally, of course, as Nupesh Bhai said, the industrial and commercial coolers also will over time help us even out the seasonality.
Right, sir. That was helpful. Thank you.
Thank you.
Thank you. The next question is from the line of Maithili Balakrishnan from Newmark Capital. Please go ahead.
Yeah, hi. Can you hear me?
Yes.
Yeah.
Okay. Just a couple of questions. First of all, thanks for the opportunity. I wanted to understand from you that, while our current supply chain depends a lot on outsourced vendors, given this COVID crisis and, from a longer term perspective, do you think that is something that will continue, or do you think that, you might want to look to change that over a period of time?
Do you mean to say change to captive manufacturing?
Yes.
No, not at all. That's something which is completely against our philosophy. I said at the outset that, in fact, this current situation itself is a validation of our strategy of an asset-light variable cost business model. Doing anything sort of resorting to captive manufacturing would go against everything that we believe in.
Got it. But then in case of these kind of disruptions, do we still, is the robustness in the vendor supply system enough to sort of help us manage even these kind of disruptions which have happened?
Your voice wasn't very clear, but I guess you're asking if the disrupt. Could you repeat your question again?
Sure. I just wanted to check with you that, we have seen a kind of a big disruption with COVID, with the lockdowns and, stuff like that. And just wanted to check with you that, do you think that your vendor system which you have built out is robust enough to sort of handle these kind of disruptions, or do you think that it does have an impact in terms of, your own ability to supply products in the marketplace?
Okay. So, thing is that our products are, we have OEMs who supply, who sort of manufacture, who assemble the final product. But then there are tier 2, tier 3, tier 4 suppliers. So the supply chains are, in today's day and age, fairly extensive and global. So there is disruption. So there are maybe some components which are being imported by us directly or by our suppliers. Some raw materials are also are imported. So there have been disruptions of all kinds. And so no amount of, I would say, centralization of manufacturing would have helped overcome that. In fact, would have actually made the situation worse. It is because the supply chain is so dispersed, and there are alternatives. For at every level there are alternatives. We are not dependent on any one supplier for anything. So it is that diversification of supplier base which also helps us at times, especially like these.
Got it. I also wanted to ask you a little bit about the unorganized as well as your own market share in the market, given that certain competitors might exist. I just wanted to get a sense from you that are you seeing that some of the unorganized players might be exiting the market, some of even the larger organized players might be looking to exit, given the situation in the market, or do you think that you are not seeing that kind of a situation right now?
So, the thing is that there have been a lot of new entrants in the market, and most of them have taken away market share from the erstwhile number 2, 3, 4 players. So as far as Symphony is concerned, the market share hasn't changed. As far as the breakup between organized and unorganized too, there hasn't been a significant change, in the last 1 year.
Got it. So it's still around 35% organized and 65% unorganized.
Yeah, give or take.
Got it. I also wanted to check with you on your Australia acquisition. This is an acquisition where you have spent, more money than what we have on the Mexico or the Chinese piece. And, the revenues have really not been in line with what our initial expectations were. So just wanted to get a sense from you on, what do you think is the longer term trend there, more, given the current situation and given what you have learned obviously about the business. Where do you see this headed, and, what are the key drivers for this business, including the US piece, and, what are your views on this?
So the Australian market is not going to grow at 30-40% ever, unless we get into new products. But we'll certainly be able to turn around the company and make it profitable. So that there is a respectable sort of return on capital employed that it generates. But most importantly, the Australian subsidiary is also giving us access to the US market, which we spoke about a little while ago. And the growth opportunity is more in the US market than in the Australian market. But it is the subsidiary to totally, which is, I would say, because the US market will be served by the Australian subsidiary, and so the company as a whole will grow, but not in the Australian market as much as in the US market.
Got it. In terms of exports in general to countries which are a little more, India-like, which has this kind of an arid weather, or we're not really seeing that pick up in a very large way. So just wanted to get a sense from you as, do you think that can change with, or is it more like a cultural aspect of people preferring air conditioners in those markets? For example, the Middle East or Egypt, North Africa, those kind of markets.
No, globally the market for air coolers is quite large. But either you have local players or there are imports from China. But we are, I would say, one of probably the largest. It's a very, very fragmented industry. So I would say we would be probably the largest exporter of coolers, in the world at this very small level. We'll be exporting more than any Chinese company would be exporting. But then we also compete with a lot of local manufacturers everywhere, especially in the Middle East and Southeast Asia. And so the markets exist. And also what has happened to us is, in the past, we have developed Middle East markets, and then in the last few years we have had this issue of, the political situation, the ISIS and all of that. So some of our major markets, especially Iraq and all, Egypt, Iraq, all suffered a setback. So it's been a sort of game of snakes and ladders, especially in the Middle East. Which is why, the acquisitions have helped us in making inroads into new markets. So were it not for the acquisition in Australia, we would have never sold what we are going to sell. Or were it not for the acquisition in Mexico, we would have never sold what we are selling in Mexico, and so on and so forth.
Correct. Thanks a lot.
And acquisitions are also giving us an opportunity of market access for Symphony residential air cooler. So even though climate technology was manufacturing and selling air cooler, but the kind of residential air cooler range what we have, they were not present into that. So starting last year, we have started supplying to local Australian market, and because of them, for Symphony residential air cooler, we have got an access even in US. And same is the case even for IMCO.
Got it. Sir, I just wanted to check this.
Thank you. As there are no further questions, I would now like to hand the conference over to the management for closing comments.
Yeah. Thank you for participating, and thanks Equirus for organizing the call. Thank you.